right, let me adjust this camera here, everybody. There we go. Maybe. Come on. There we go. All right, how's everybody doing? It is really good to be back here. I know I was out last week, had a family wedding. My son got married, but it is amazing to be back down here. And yes, we are in the thick of things now. Labor Day holiday is over. Okay, no more holidays coming up until I think one day off in October. And boy, leading up to the election, this is going to continue to be an extremely volatile environment. Who knows what's going to happen? We got the debate tonight, CPI tomorrow. So there is no shortage of news on what can affect the market, everybody. And, we're all going to, be tuning in or see highlights of what happens tonight. And I'm sure you're going to see lots of headlines tomorrow about one side was better than the other, one side won, and the odds are going to be changing, and you're going to see all these recommendations out there on, boy, if it's a Trump win, these are the stocks you want to be in, these are the sectors you want to be in, and if it's a Harris win, these are the stocks, these are the sectors you're going to want to be in. So we will certainly cover those, but you know what? It's way too early. It is way too early, in my opinion, to even go there yet. But probably at the start of October or so, we will start getting into that. Now, what is going on in the markets right now? We were up pretty decently early on, continued the rally from yesterday. We saw S&Ps up over 20 points or so at one point, and then about 45 minutes ago, an hour or so ago, we saw a big slip in the market as rates started to tick up a little bit. Bonds sold off, rates ticked up. So market sold off. SPOOs were down almost 30 points, maybe 30 points at one point, and now recovered almost all of that. We're getting closer to the flat line. S&Ps are down about 10 points right now. Volume pretty decent in S&P futures, almost 1 million contracts so far. Typically about 1.5 million is average daily volume there. As I'm going through here, and I've got the board in front of me here, I'm going to let you guys know because I've seen some big orders crossing the tape here. I'll let you know what's happening out here. But what I really want to discuss is what's front and center besides the debate, besides CPI, front and center. Well, of course, we've got the Fed, right? Everyone's been talking about the Fed for weeks, months on end. We know they are going to cut rates next week. And yeah, it's next week finally. It's no more month out, 2 months out, weeks out. It is next week. Next Wednesday, a week from tomorrow, is when the decision will be made. They actually start their meeting next Tuesday. The question is, are they going to cut by 50 or just 25 basis points? And, you're going to see all of the rhetoric out there from everybody, also opinions on what they should do. Are they behind the curve? Yes, they're behind the curve. But you know what? I think right now you see Jerome Powell, or if you could see him, he's probably in his office, and he's probably got his feet up on his reclining chair and his feet up on a desk right now with a cigar in his mouth, because we've seen inflation coming down. I wouldn't say that battle is finished yet, but certainly seems to be under control. And we've got labor market stalling or slowing down. Now, you would think that wouldn't be a good thing, right? We all want everybody to get jobs. We want to see that robust economy. But for the Fed to be able to start really hammering rates, which is what they're going to do, that's what they need to see. So we're going to go to our screen here, what we see on the board, as we always do. And right now, here's our current Fed fund rate target, 5.25% to 5.5%. At the meeting next week, as we stand right now, 67% chance that they're just going to cut by a quarter, 33% chance that they're going to cut by 50 basis points. That probably doesn't change much between now and next week, unless we get a real outlier of a CPI print tomorrow. That could be, in my opinion, the only thing that would really make a change here. I think they're going to cut 25. I've said for a few weeks now, that should be the number. Even though they maybe should cut 50, they won't. And I think they won't because of two reasons. One, I believe that would show an incredible sense of panic to the marketplace. Like, uh-oh, we really are behind the curve here. We got to start catching up. So that's number one. Number two, yeah, it's the election. It is the election. Hey, Gary, that's a great question. I'll talk about that in a second. The election, right? One side wants to see cuts, the other side doesn't want to see them. Actually, both sides really want to see cuts, but ahead of the election here, one side is in favor, the other side is not. The Fed really is. Say what you want about the Fed, but historically they are really mindful of politics. They are really mindful of elections, and they don't consider that when they are making their decisions. So, is it in the back of their minds? It probably should be. It really should be. So, for both of those reasons, I think 25 basis points is the appropriate move. Now, Gary asked, does the extra 25 basis points really matter? In the long run, no. 3 months from now, no. Maybe even 2 months from now, it absolutely does not matter because the market is pricing in now we can show it on the screen here. The market's pricing in consecutive cuts over the next basically 6 meetings or so. But it's just the impression that they would leave that if they actually cut 50 now, it shows a little sense of panic. It shows that, yeah, maybe they're admitting they're behind the curve. So in the long run, Gary, it does not matter. So, Kenneth, let's take a look at this now. Kenneth said, I keep hearing we've priced in 8 cuts. How do they calculate? Okay, so what we're looking at on the screen right now, guys, this is for the Fed meeting next week, 18th of September. Okay, and again, 67% probability of a 25 basis point cut, 33% probability of a 50 basis point cut. Now, how is that calculated? Kenneth and everybody else, that's actually calculated from how the Treasury market is trading right here in this building at the CME. Even though I'm on the SIBO floor, this is the Chicago Board of Trade building where the CME is at. So that is all based on how the Treasury market is trading, and that is live up to date. Now, the next meeting after this September one is only about 6 weeks afterwards, at the beginning of November. So here are the odds of what the next cut would be. Okay, and there is a 100% probability of a cut at the next meeting. Is it going to be 25, 50, or are they even going to bring it down 100 basis points from where we are right now? Okay, seems like the sweet spot, at least, the best probability right now, a little better than 50%, is that these rates would fall into the 4.5 to 4.75 target rate. Remember, right now, before any cuts, before September, right now the current target rate is 5.25, 5.5. So right now the market is pricing in the probability a little bit better than 50% that by the November meeting we will be at 75 basis points lower than where we are now, whether that is 25 in September and 50 in November or vice versa. Then we go out another month to the last meeting of the year, which is right before Christmas, right before holiday time, when typically they don't want to rock the markets whatsoever. They don't want to rock consumer confidence whatsoever that time of the year. So we can see going out to December, which would be the third sequence of cuts, okay, that with a almost 80% probability, we're looking at rates that are going to come in between 1 and 1.25% lower than we are right now. Does everybody see that? Does everybody understand that? What I'm circling, what I'm explaining right now, what's on the screen. And you can go to this website anytime you want. You're going to get live up to the minute, up to the second data on how treasuries are trading and what is priced into the marketplace. Okay, excellent, excellent. But so that's three cuts. Okay, again, we don't know the exact sizes of those cuts. That's three cuts. Now, let's fast forward into 2025. Can't believe we're talking about 2025 already, but here we are. Now, all of a sudden, look at this. Now we've got basically a 70% probability that we're going to be 1.5% lower or more, or more. So 100% probability that another cut is in the works in January. Okay, and then so on and so forth. I don't have to, walk everybody through this, but you can go through the whole progression here. And let's just take a look at what the markets are predicting 1 year from now. Okay, so if we go out to the September meeting of 2025, okay, look at that. Look at that. The September meeting, the highest probability is that we'd fall in the 275 to 3% range, which is 2.5% lower than we are right now. But if you look at all of the rates from that target rate of 275 to 3% and lower, so if we take all of this into consideration here, what do we have? About a 60% probability, a little bit more than that, I think, that we're going to be 275 or lower. Okay. Now, obviously, that can change in a heartbeat, guys. What is that based on? That's based on GDP. That's based on PCE, CPI. It's based on jobs numbers. Okay. If the jobs market all of a sudden starts to pick up a little bit and we don't see this drop off that we've seen recently, that can certainly change, and rates would then tick up appropriately. They would tick up a little bit higher. But for right now, again, these are not just odds out there on a a betting market anywhere. These are all based on how treasuries are trading. Okay, and it changes up to date. The expected 8 cuts, I think that's between now, Bill, and this time next year. Okay, 8 separate cuts. Again, we don't know the size of those cuts. Are they 25? Are they 50? But 8 times that they more than likely, at least right now, are going to cut. But again, keep this, okay. Yeah, guys, let's see what just. Oh, November. So November 5,000 calls. November 5,000 calls in the S&Ps. Broker just bought 3,000 of them. That's what you just heard sold from the crowd here. If you could see that, let me pan on over here. Okay, so you had a buyer come in, and I don't know, that coincided right there with the market actually ticking positive there. Okay, Paulie, are those kinds of projections available for international markets? That's a great question. I imagine they would be. I imagine if you looked at the yen, so the Japanese markets and the Japanese treasuries, you could probably, come up with something similar, or the euro or the pound. In fact, Paulie, what I'm going to do is, Michael, if you can make a note of this for me, please, I'm going to do that research and I'll present that on Thursday where you can find that information. Okay, so that's a great question. That is a really great question. But know that honestly, the rest of the world kind of follows what the Fed does. Okay, the U.S. markets are the leaders. The U.S. treasuries are the leaders. The rest of the world really follows what is going on here. Let's take a quick look at the VIX here, guys. We saw the VIX get to 21, 22 the other day. It's trading 19.5 right now. It got up to just shy of 21 here today. And here is the VIX curve. And you can see after the election, it is really, really flat. It is really flat. So once we get to the election here, the market's not expecting a ton of excess volatility. Okay. This is the term structure. What do we make of that? I don't know what to make of that. Just because the election is, less than 2 months away at this point, that doesn't mean after the election, some of the issues that are out here are going to go away. So I do think that we will continue volatility. But remember, what does the market trade on? Or what does volatility trade on? It trades on uncertainty. What is the biggest uncertainty to our markets and realistically global markets at this point? Yeah, it's the election. It's the election. But just keep in mind, guys, we talked about this a few weeks ago. Honestly, the markets don't care who wins. It really is not going to make a difference to the markets who wins. Okay, there's such a slight discrepancy whether there's a Democrat or a Republican in the White House. A little bit more so when you combine who controls Congress. But at the end of the day, the markets are going to be what the markets are going to be. All right, we got to look at some stocks here. We got to look at some stocks that we are. What is going on here, Mike? I lost my team viewer again. Damn connectivity on the SIBO. There's already a connection. Okay, there it is. Okay, my bad. There we go. Here we go. Yes, like the stream to keep these coming. I agree. What's big in the news today? Banks are big in the news today for a couple reasons. Goldman Sachs, they came out and said they're taking a big charge, about a $400 million charge. So that's number one, putting pressure on. Number two, JP Morgan and some of the other banks. JP Morgan's not chairman, not Jamie Dimon, but their president came out today and said that their net interest income is likely to be lower in the coming months, in the coming quarter, than what was already factored in. Now, what is interest income? How do banks make money, guys? Banks make money by borrowing cheaply and lending it out more expensively. That's their spread. Okay. As rates come down, that spread's going to narrow a little bit. So I think what they are seeing and what the banks are seeing is that now that it seems as the Fed is going to be extremely, extremely aggressive, they have got to absolutely take that into consideration and think about how is that going to affect their bottom line. So is this move in the banks, specifically JP Morgan, is that justified today? I don't know. Maybe it is. Stock's down 6.5%, 7%. I mean, that is a massive, massive move for JP Morgan. So let me show you guys something because my go-tos are on some of the technicals are 50-day, 200-day moving average. This is JP Morgan over the last year. What do you guys see here? I mean, if this is not the classic staircase higher, okay? Boom, 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 boom. Higher highs and actually higher lows, okay? Now here you can maybe say that those two lows right there may be the same, but higher highs and higher lows, that's incredibly bullish, guys. Did it again here, and now we've got this big drop off here. So I like looking at the 50, the 200-day moving averages on this screen right here. The 50-day is this red line right here. The 200-day is this blue line. Okay, we haven't had the 200-day since all the way back here, which is, when was this? This was almost a year ago, November of 2023. But since then, multiple times, we have seen test the 50 and bounce, test the 50 and bounce, test the 50 and bounce, test the 50 and bounce. So that's what I'm seeing today here, guys. Of that, the big drop, 6-7% drop, just below the 50-day moving average. Okay. But also, what do we have today? Let me get this here. Now we're looking at implied volatility. And, you know, when we look at implied volatility, when we compare different stocks with their option premium, their option volatility, okay, we can't just say, oh man, JP Morgan is trading at 28% now, and compare that to another stock, Nvidia, Tesla, Google, whatever it might be. Every stock trades at its own levels. Every stock trades in its own range. But if we look right here at JP Morgan, what does this tell us here? Boy, this is almost as high as it's been in the last year, and it's not even earnings. You know, we'll see those spikes around earnings. And then, you know, we know that we get a quick drop off because we get, what do we get around earnings? We get uncertainty. That's what makes option premium go up. That's what makes volatility go higher. But here we've got massive, massive premium, massive extrinsic value implied volatility in JP Morgan, and it doesn't have to do with earnings. It's all that news today. So if we want to take a bullish position, and we also see that implied volatility, option premium is expensive. If we combine those two, what do we want to do? We want to get a position that gives us positive delta because that is the bullish position, okay? But we would also want to sell premium because options are so expensive. So what do we do if we want to have a bullish position but sell premium? Well, you could just sell a put. I'm not a fan of selling just a naked put because you then have unlimited risk with the stock going down to zero. So we sold a put spread. We sold a put spread today, a very expensive put spread, in my opinion. We sold this put spread that expires next week, give it a little time to breathe. So this expires next Friday, the 20th. We sold the 207.5, 202.5 put spread. Yeah, that's a little bit in the money, right? The stock's only trading 203. So it's a little bit in the money. Okay. But we got a credit of $3 for that. A credit of $3. That's a really, really rich number there. That is a very, very nice credit that we receive. So if we look at, and we always have to look at reward and risk, right? We have to measure the size of our positions based on the risk that we have. So I want to go through this with everyone. If we have a $5 wide spread that we have here in JP Morgan, okay, even if the stock went to zero, okay, which if that happened, we'd obviously be in a lot more trouble than just this position. But even if the stock went to zero, or, you know, more likely just below both strikes, the maximum this thing could be worth is the difference between the two strikes, $5. No matter what, that is the maximum this could ever be worth. Well, we took in a $3 credit. So even if this thing went to $5, which we wouldn't want it to do that, but even if it went to $5, what is our maximum risk? Our maximum risk to this put spread is only $2. So if you were trading this put spread, if you actually, you know, did this in your portfolio, you would use $2 per spread as your risk. Collecting 3, the most you could lose is 2. So let's say, again, how would you size this appropriately? Let's say whatever allocation you're using, you put $1,000 risk into any one position, into any one spread. You would do 5 of these because each position, each spread would have risk of $200. Okay, so hopefully that clarifies a little bit how we look at risk allocation, why it's so incredibly important to understand your risk allocation. So what, you know, I hear a lot of new people doing, and what I get asked questions about all the time on allocation is, how many spreads should I do? Should I do 1 contract? Should I do 5? Well, that's all dictated by the amount of risk. So not by the amount of contracts, but by the amount of risk that you have on. Okay? S&Ps are back positive again now. They are up 3 points. Okay, one more I need to go through here, guys, because this is so incredibly important when we're looking at some technicals as well. Okay, and if anybody has a question or want me to go through a particular stock, we've got about 5 minutes left here. Let me know. I'm happy to do that. A position we took yesterday, literally yesterday here, guys, Broadcom. Okay, AVGO. Here's Broadcom. This huge dip here, actually, from right here, that was on earnings. That was on earnings last week. Look at this chart. What do you guys see here? What does everybody see here on this chart? Okay, I see some incredible support on that red line, the 50-day moving average, which is going back over a year. But then the more important line, the blue line. Okay, no, not hockey ice rink blue line, but the blue line 200-day moving average, support and support. Guess what we did yesterday? Right at that support, right there, we bought a call spread. We bought a call spread. Yeah, and Paul, it might fill the gap. It might. It's well on its way to fill in the gap right now. This stock's up $7 today. But we bought based on that 200-day moving average support. We bought a simple call spread. We sold half of it on the opening today. Now, we sold the balance. We sold the balance a couple dollars ago in the stock. So can we look back and say, oh, why did we sell so early? Well, you could. We made 60% overnight in this position. Okay, we made 60% overnight in this position following our technicals. Following our technicals. John, the red line here is the 50-day moving average, and the blue line here is the 200. Okay, now, Paula, you mentioned the gap, and we talk about gaps a lot. Yeah, there's a gap right here from earnings from last week. This is November 5th, just last Thursday. Okay, and that gap is actually at about 152.80. If AVGO gets to that 152.80 level, whether it's today, tomorrow, next week, a month from now, 6 months from now, whenever it might be, okay, this area that you see right here where there's no trade, that will signify at that point some resistance. That will signify a potential short area if we get up there. Okay, so something to keep in mind. Gaps are incredibly important. The longer the time frame the gap has been out there, the more significant it's been. It is. And this one's only been out there a week, a little over a week or so, or it's going to be a week tomorrow. Okay. So this was great today, guys, because the two things that I really wanted to go through from technical analysis, from looking at what we do here, and then taking advantage, how to take advantage of a potential position, whether we want to be bullish or bearish, whether we want to buy premium, have a debit spread and pay for it, or sell premium, collect money like we did with JP Morgan. Two completely opposite examples there, which we've done over the last 24 hours. So we will be back live on Thursday, everybody, and that'll be post CPI. So we'll have a better look into what the Fed may do next week. That 67.33 that we were looking at for right here, that's 67.33. That, I'm sure, is going to change. Let me get that back up. There it is right there. That will change after CPI tomorrow. And we'll talk about that on Thursday. Now, I want to give a quick shout out or a quick note to everybody. After the close today at 3:40, that's Central Time, 4:40 Eastern Time, you can see this up in the chat here. We are putting on a live webinar. They're always live for our Funder, Funder, Funder Trading Program. And that is our program where we actually fund traders, where you don't use your capital, you use our capital to trade. So if you're interested in finding out more about that, there's the link up top there, 3:40 Central, 4:40 Eastern time later today. There we go. Bob, thank you. I was just going to answer that. Mike answered that for me, so that'll be on our YouTube channel. All right. Thank you, everybody. Appreciate you tuning in. And as we speak, as I head out here, S&Ps are literally at the flat line for the day. All right, everyone. Have a fantastic day. Pretty quiet here in the S&P pit right now. Have a fantastic day. Appreciate all of you. We'll see you on Thursday.